Hello, this is George McAllister with Insuel, and I'd like to welcome our listeners to today's podcast session. We're pleased to have Doug Sherlock, Senior Healthcare Analyst for Sherlock Company, joining us today. Doug is here to give us his quarterly insights into financial markets of health plans.
Well, thanks, George. In this podcast, we'll review the performance of the managed care industry for the second quarter of 2021 and year to date. We'll also discuss sector valuation indicators and operating trends. This will be an unusual presentation in that it is impacted by the effects of 5 new health plans added to the universe so far in 2021. This will bring our total of our coverage to 12 from 7 previously. As always, we only use comparable plans in trends, and this convention will be used in the body of this presentation. Trends in valuation metrics is of the 7 continuous plans for the year-to-date comparisons. Operating trends include all plans because when companies go public, they were able to offer some historical values for their for comparison purposes. So first I want to speak to stock prices and valuations for the continuously participating plans, that is, excluding the 5 new ones. As of August 16th, stock prices for the continuously public traded health plans are up by an average of 10.6% since the beginning of the year. Similarly, health plan sector market capitalization increased by 14.1% year-to-date. Overall, the increase stemmed from broad increase across the plans. This 14% increase, or 10.6% increase, compares with the 19.3% increase in the broader market measured by the S&P 500. Stock prices for all 7 plans gained ground so far this year, led by Molina at 19.1%, followed by United at 19%, Anthem at 17.2%. Triple S increased by 10.4%, Centene by 6.7%, Cigna by 1.3%, and Humana by 0.5%. The valuation metrics were all higher since the beginning of the year, with price to trailing 12 months earnings increasing by 26.9% to 19.7 times, and price to operating earnings growing by 48.3% to 20.8 times. Price to projected 2021 earnings was higher by 11.2% to 14.9 times. Price to sales increased by 1.8% to 0.71 times. Price per total member increased by 8.1% to 3,600, and price per risk member grew by 5.2% to 5,700. For comparisons from our latest podcast, the plans compared are all plans except for Bright Health Group. That is a total of 11 plans. Since our last podcast in May, health plan valuation metrics were lower for price to sales, price per risk member, price per total member, and price to 2021 earnings. Price to operating earnings and price to earnings were higher. This reflects lower second quarter 2021 earnings and operating earnings relative to the second quarter 2020, while stock prices fell at a slower rate. The average health plan stock prices are lower since the last podcast by 9.8%, with the health plan market capitalization decreasing by 3.7%. The S&P 500 has gained 8.5% since May. The newly public companies generally declined in value since they went public. As of August 16th, 4 of the 5 newly public companies are lower. Oscar has fallen by 65%, Clover by 47%, Innovage by 34%, and Bright Health by 41%. Uniquely, Alignment Health is higher by 13.3%. On to our review of operating trends. Before I begin, there's a reporting nuance I want to point out. All of the plans except for InnovAge are on a calendar fiscal year. InnovAge's is their fiscal year ends on June 30th, 2021, and therefore is not yet reported. So its most recent results are from the latest available period, which is ended March 31. For the second quarter of 2021, combined ASO and risk membership increased by an average of 37.7%, while increasing by 5% in total to 144 million members. By average growth, I mean the average of each health plan's growth rate. Total reflects the change in combined membership of these publicly traded plans as a whole. Fully insured risk membership increased by an average of 31.5% and in total by 9.9% to 85.3 million members. Notably, among the commercial plans, Bright Health grew 211% to 705,000 insured members. Medicaid plans experienced an average increase of 20.8% and a total growth of 13.6% to 22.6 million members. Medicare plans had an average increase of 15.4% and total growth of 8.1% to 7 million members. The total membership of Clover Health was 128,000 members, of which 62,000 were from direct contracting, a new business for the vertically integrated Medicare plan. The proportion of total members served under self-funded ASO arrangements fell by 2.7 percentage points to 40.8%. On average, the plans posted a 1.9% decrease for this product, and ASO membership was down in total by 1.5% to 58.9 million members. Revenues for all plans increased by an average of 77% and a total by 15% to $176 billion for the quarter. Medicaid plans reported $38 billion in revenues, an average increase of 30%, and a total increase of 17%. Molina posted the largest percentage gains for Medicare plans, up by 47% due to acquisitions over the past year. Commercial plans increased by an average of 114% and in total by 15.3% to $117 billion. Oscar and Bright Health posted percentage increases in revenues of 364% and 262% respectively. In the Medicare segment, plans reported $21.3 billion in revenues, an average increase of 45.5% and a total increase of 9.1%. Clover Health's revenues increased by 139.7% due to its participation for the first time as a direct contracting entity. Premium rates for all plans grew by an average of 9%. Medicaid and commercial plans experienced average premium growth of 7% and 13% respectively. Medicare plans' premium rates increased by 5.9%. I do want to add, as I always do, that the premium rate growth does not adjust for changes in product mix, geographic factors, or benefit design changes within the products offered by these plans. Operating earnings for the plans in the second quarter totaled $10 billion, a decrease of 46%, or by $8.5 billion. United Health, a commercial plan, had the largest change in operating earnings from $8.9 billion to $5.4 billion, a decline of 39%. Average operating margins for all plans decreased by 9.9 percentage points to negative 4.4%. This was due to the newly public plans that all had negative profit margins at an average of negative 17.3%. When the newly public plans were excluded, the average profit margin was 4.8% for all plans, compared to 12.3% a year prior. The health benefit ratio for all plans increased by 13.4 percentage points to 88.1%. The average health benefit ratio for commercial plans was 85.4% versus 73.2% in the second quarter of 2020. The average health benefit ratios for Medicaid plans increased by 6.8% to 84%. Medicare plans had an increase of 18.5 percentage points to 94.2%. Notably, Clover had health benefits ratio of 111.2% versus 70% last year. The administrative expense ratio decreased by 1.6 percentage points to 15.3. Commercial plans had a decrease of 4.3% to 14.9%. Medicaid plans reported a decrease of 1.9 percentage points to 13.1%, while Medicare plans experienced a 2.6 percentage point increase to 17.8%. Excluding the recent publicly traded companies, established plans tell a different story in administrative costs. When looking at solely at plans public prior to 2021, commercial plans had an administrative expense ratio that averaged 9.6% as compared to 14.3% in the second quarter of 2020, and Medicare-focused Humana had an administrative expense ratio of 6.5% compared to 8.5% last year. The Medicaid universe's ratios were unaffected by the additional plans, since Centene and Molina were the only two plans in this universe. Non-operating earnings increased by $1 billion. Our calculation of non-operating income is the sum of investment earnings, income earned in non-health lines of business, less interest expense. Medicaid plans reported a loss of $122 million for non-operating earnings compared to a loss in the prior year's quarter of $85 billion. Commercial plans had an increase of $988 million to a total of $1.7 billion. This was driven by Anthem's non-operating earnings increase by $480 million to $268 million. It was also driven by Cigna's non-operating earnings of $1.1 billion relative to the prior comparable quarter of $821 million. This includes the Evernorth subsidiary, which is better known as Express Scripts. Net earnings for the second quarter were lower for the plans compared to the stellar second quarter of 2020. This comparison is an aberration due to the low medical loss ratio from the lack of medical utilization as COVID-19 lockdowns were occurring. Net earnings decreased in total by 39.5% and 36.1% on average to $8.4 billion. Medicaid plans had net earnings of $844 million, a decline of 37.4%. Medicare plans had net earnings of $182 million, a decline of 69.2%, and commercial plans had net earnings of $7.4 billion, a decline of 24.3%. I want to close by touching on a key environmental factor. As I mentioned earlier and in the previous podcast, there have been several new newly publicly traded health plans, bringing the total to 12 from 7 previously. These include Bright Health Group, Oscar Health, Clover Health, Alignment Healthcare, and Innovage Holding. They are small at 1.5 million members. They represent only 1% of the sector total, but they've attracted investor interest since they are 1.5% of the sector's market capitalization. It was even greater when they had their initial public offerings. These are companies that offer important innovations. Most are Medicare Advantage. One is vertically integrated, and another leads with a customer-friendly platform. Because they are all new, they are free to experiment in ways that might be more difficult in established firms. Having said this, the core businesses of these plans is health insurance, subject to the same pricing and cost constraints of other health plans. In other words, they have to successfully execute as their more established peers. We should anticipate declines in the administrative expense ratios from current levels of 22.4% for these newer firms, 29.4% including the stock-based compensation, to levels found in their peers of 10.1%. Of course, differentiation and the effects of vertical integration may have an effect on reported administrative cost values. Also, we expect that some of these higher administrative expenses of these new companies are sales and marketing, that is, investments in their futures. Many health plans begin their decisions about administrative costs for 2022 at the end of the summer, that is, right now. Presumably, they are seeking to make decisions about optimizing administrative costs rather than merely achieving low costs. The difference between low and optimal costs is that amounts above the norm should be evaluated based on an expected ROI. But this requires norms to understand the additional investment in sales and marketing, cutting-edge information systems, or medical management, for example. The Sherlock benchmarks offer those norms for Blue Cross Blue Shield plans, independent provider-sponsored plans, and Medicare and Medicaid universes, which will be available in the next month. Please let us know if this is of interest. You will be among good company. As always, you can get a transcript of these remarks through MCOL or through Sherlock Company. We look forward to hearing from you. This is Doug Sherlock of Sherlock Company.
You've been listening to Doug Sherlock share his quarterly insights into the financial markets of health.